There's doing good. How are you doing? It is another week. It looks like it's going to be a beautiful. We're going to get some cool weather at the end of the week. I'm looking forward to that. I agree. I grew up in Michigan. Where did you grow up? I agree. I I did like you. I did not grow up in Houston, so I still feel like summer is oppressive, and so by the time fall comes, I feel relieved and I enjoy spring, and then I have this little bit of dread about summer. But I'm getting used to it, and I'm not complaining. I spent 3 years in Pennsylvania, and in January, I called one of my friends who lived in Friendswood, and it was 72 degrees, perfect blue sky, and it was like 10 below in Ridgeway, Pennsylvania, where I lived. So glad to be back to Houston. Yeah, it's all right. So let's see. It's 10:03. I've got several people in the waiting room. I better admit them. We should be live on Facebook and YouTube now. We'll get started here in just a minute. What do you think about that fancy background? Is that too distracting, Erica? Cool. I like to play with things, and I'm just playing with this. I got to the office a little late today, so I didn't have the normal setup, but I like that. I think it's kind of cool. I call that my B-roll. Money Study Group B-roll 1 and B-roll 2. That's what's playing in the background. Just two videos I threw together with a bunch of images and with some transitions, and it's my hobby. Good. Okay, let me admit some more people. And I see everybody is chiming in with their role, saying you're here. That's great. I should record this meeting just to make sure that that will allow me to record all the comments. And if anybody has any pressing needs, you can post those there, and I will be able to grab them after the Zoom meeting ends. Okay, one more minute and we will jump in to begin. So if you have any questions, now's a great time to post them. Any questions about any assignments or what's coming? What's coming is we're getting ready. We're going to do insurance today and insurance next week. Insurance is a big topic, and I'll tell you why in a minute. But after that, we're going to be focusing on investments, which is always the most popular part of the course, and it's certainly one of my favorite things to do. So we'll do insurance this week and next week, and then we'll jump into investments. And we'll do investments for 2 weeks, and then we'll be into retirement, really your capstone, essentially. And that's kind of where we'll wrap it up. We're getting very close to the end of the semester, so looking forward to what's to come. Okay, I don't see any questions. Don't see anybody waiting to get in, so let's get started. Insurance 101. This week we're going to focus on property and casualty insurance, and I want to spend a little time to help you understand what I think every consumer should know about insurance. So there are 3 reasons that this topic is important, in my opinion. Number one, as a consumer, and when I say important, I mean 3 reasons why insurance is important to you as a consumer, as a student in Money Study Group in this personal finance course. three reasons that insurance is important is, number one, it's going to be a big component, a big category in your budget. So just in terms of managing your personal finances, insurance is a big ticket item. So it's helpful to know how it works so that you can be a smarter consumer. And that's really my number one goal, is to help you become a smarter consumer in the area of insurance. It's a very challenging goal. And that brings up point number two. The second reason that insurance is a very important topic for this course is because of its complexity, because it's not easy to, it can be overwhelming. There's so much information involved in insurance. Lots of fine print, lots of details that are difficult, make it difficult to choose the right policy, the right package. And so a lot of times people just kind of avoid it, or they do the next thing that's number three. The third reason that I believe insurance is a very important topic for you to understand, and that is professional advice. And these days, you know as well as I do that professional salespeople and companies in general, marketing is such a powerful thing. And when you add the force of a sales professional who's been trained to sell you something, the professional advice that you get in the arena of insurance can be very questionable at times. And so I believe that it's on you to learn what you need to learn about insurance in order to prevent yourself from being duped by a well-trained professional who's trying to sell you something. Now, having said that, I want to just kind of point out there are probably, last time I checked, somewhere, I want to say it's over 100,000 professionals who sell insurance, well over 100,000. And if you think about it, there are so many professionals who have a license who are really not well trained, but they have an opportunity to sell a product. And they have a lot of rules, boundaries, and limitations. So, for example, I spent much of my professional career as a State Farm agent. It was a wonderful opportunity to make a very good amount of money. It was a great opportunity to serve people well. And I tried to do that. But in my role at State Farm, I had the opportunity to do quality control before I became an agent. And that gave me some insights about the different ways that even at one company, there's a wide range of approaches and motivations for professionals who sell stuff. And so you got to be able to make some good decisions on your own. And when you look for a professional in the area of insurance, it's my belief that you're looking for great service. Advice is critical, but advice really needs to come from a fiduciary, someone who has your best interest in your best interest at hand, in heart, in their heart. You know what I'm saying? And if you don't know the definition of a fiduciary, I would encourage you to, let's make that part of this week's assignment. Just go find the definition of a fiduciary. I'm going to add that to the assignment and understand what that means. So a fiduciary has a legally binding requirement to give you advice that's in your best interest. And that's just not true in our industry. It's not true in the financial services industry in general. It's certainly not true if you're working with a professional who has an insurance license. Their obligation as an agent or a representative of the company, whether it's at Morgan Stanley or Merrill Lynch or Wells Fargo or State Farm or Edward Jones. I don't know much about Edward Jones, but I can tell you they're all employees. And if you're an employee, just think about it. Your commitment, your number one priority is to the company. You're obliged to follow the parameters that are laid out by the employer. And so It's very difficult to get fiduciary advice from Wall Street or from any financial services company. So you need to know enough to make well-informed decisions. And when you get to the point where you're spending a lot of money, it helps to have a fiduciary, someone who's trained and professional, to give you good advice that fits your goals and your needs. So back to the three things. Number one, it's expensive. Number two, it's complex. Insurance is complicated. And number three is you're going to always be faced with the challenges of working with a professional who almost always is compensated to sell you stuff. So for those three reasons, I would encourage you to pay attention to the topic. Pay attention this week as you learn a little bit about insurance. Today I'm going to just tell you some stories from my own background, some stories that I think will help you understand a few of the coverages, the most common coverages that are in homeowners insurance and auto insurance. So there's a whole lot more to insurance than just homeowners and auto. And in your course, you're going to find some reading material and some helpful information that will give you a whole lot better insight about the different coverages in those two packages, the homeowner's policy, the renter's policy as well, and the auto policy, and the personal liability umbrella policy. So I just named 4 different policies, and it reminds me that I teach another class. I don't just teach at the University of Houston. I teach at Rice University as well. I teach a course on insurance at Rice University in the CFP program. So it's a very different group of students. And I'll tell you that my first time to teach that course at the university, at Rice University, I had a focus to teach the same way that I teach here at the University of Houston. And that didn't work out so well because professionals who are in the insurance business, they're primarily looking for the same thing I was looking for when I joined the insurance business. As a State Farm agent, I spent 6 full months in training. And that's all we did was we were training on products. We were training on what the compliance rules were, how the company worked and operated. There were so many things that were what I would consider to be minutia, meaningless minutia. Because what happens is if you go too deep into a subject, we call that inside baseball, and very few people need or want to go deep into a subject. Now, you may notice I have a lot of letters after my name because I've got a lot of designations in the area of insurance. So when I taught at Rice, I believed, in fact, I wrote this book called What Matters Most, and it is a story. It's basically the same thing as Make Your Money Count, except this is for professionals. It uses the same blueprint. The blueprint is designed in What Matters Most to teach professionals how to do holistic financial planning instead of getting lost in the minutia. Thus, the title, What Matters Most, was about how to help people identify what they really want out of life and then put together a plan and structure your recommendations in the insurance business. Recommendations mean your product, what you're going to sell them, to make sure that you're meeting their needs, their purpose. You have to do it a little differently than you're trained to do in the insurance business. So when I taught at Rice, I tried to bring that philosophy, that approach, but I faced a very abrupt challenge that most people who are paying big bucks to learn the minutia want someone to spend a lot more time into the minute details, and that's what was expected. And frankly, I think that's what's necessary for professionals to feel comfortable before they start making recommendations. So needless to say, that course that I teach at Rice is not my favorite way to spend my life. I don't like to jump into the minutia. And I'm not encouraging you to be a specialist in insurance. So, am I speaking out of both sides of my mouth? Not at all. There's no question that insurance, and if you want to be an expert in insurance, you have to understand a whole lot. But to be a great consumer of insurance, all you have to do is know the right questions to ask and surround yourself with people that you can trust who have done their own homework and who are going to help guide you through the specific things that really are important when it comes to the minutia of insurance. So you want to work with a professional, but you want to make your choices about where you're going to spend your dollars on insurance. You want to make those choices and those decisions as a well-informed consumer. So that's what we're going to try to do over the next week and a half. So I say week and a half because I'm hoping that I can finish up insurance a little early and then jump into investments, because investments is, again, the most popular topic. It's my favorite topic to teach, and it's one of the most important things to understand. So both insurance and investing require a lot of information to really absorb. You're not going to get it all in this course, an Introduction to Personal Finance. What you're going to get is a great foundation so that you can build on it. And you're going to get some very specific things that you can take advantage of right now. So let's get started. Let me jump over here and make a quick edit in my software. I'm using multiple pieces of software right now, and I think I just messed it all up. Give me just a second. There we go. Okay, I'm going to leave it like that. So let's start with some stories. You're going to learn this week that as we talk about property and casualty insurance, we're really focusing on when you say property and casualty, you're talking about property. So property is things like your personal property. It's also things like your house, if you own that, or if you have a piece of real estate, or your car. That's all property. So when we say property and casualty, we're talking about your property. Casualty, on the other hand, is about liability, and it's a very important concept to understand, is liability. So insurance is something that transfers risk to the insurance company. So you can keep that risk for yourself, and you can manage risk for yourself by the way you live your life and the choices you make and the things you do. So for example, today's a beautiful day. It's, 77 degrees as I speak. In Houston, Texas, the humidity is pretty low. It was a wonderful day to ride my motorcycle to work, which I did. And I ride a Goldwing motorcycle, and it's one of my favorite things to do. Every day I get to ride my bike to work. It's fun. It's way better than driving a car, even though I have a nice car and I like to drive. So some would say that's a pretty risky activity, and they would be right, I guess. Now, I do get to take the express lane, which to me is a much safe, it's like a buffer zone, like there's no cars on either side. We're all going the same direction. So so I choose to take the express lane. It's free, by the way. I wouldn't ride my bike and take the express lane every day if I had to pay the toll. I would have to pay the toll if I was in my car, but I'm on my motorcycle. It's one of the reasons that I can justify driving a motorcycle to work every day. I get on the express lane down in Houston, down in Friendswood, and I get off right at the University of Houston. My office is at the Technology Bridge, so it works out great. But that's an activity that has a certain amount of risk that I choose to take for myself. Now, I could protect myself and my family and my assets against a peril or something that could happen to me as I'm driving my motorcycle. Think about some of the things that could happen to me on a motorcycle that are not likely to happen if I'm in a car or a pickup truck. There are lots of risks, lots of perils, and perils are important to understand because really what you're looking at are perils. Risks and specifically perils that you're buying insurance to protect against. So when we talk about homeowners insurance, auto insurance, as we talk about property insurance, we're talking about protecting yourself, your assets, the risk of loss against certain specific perils. And so that's an important category of or term to understand. So just be thinking about perils and risk management and activities, behavior, because at the end of the day, what you're doing, if you're going to be a well-informed consumer, you're making choices about where you're going to allocate your resources. And sometimes you don't need to buy insurance. You just need to have a different approach to how you manage your own activities. One example I would suggest is if you have a propensity to consume a considerable amount of alcohol or other intoxicating elements, spirits, chemicals, then you probably want to have as much insurance as you can afford, because I don't need to finish that sentence. So, on the other hand, if you're very careful about when and where you consume alcohol or other chemicals, then you're going to be in a much better position to know that you don't have to spend a ton of money to protect yourself against a catastrophic loss. So, just some basic terms you're going to want to understand. Transferring risk to the insurance company is the basic premise. You pay a premium for that. And then there's a thing called a deductible. The deductible is a deductible is what you pay out of your pocket. And if you have a high deductible, it's going to lower your premium. The premium is what you pay to the insurance company. So when you buy an insurance contract, a policy, you pay a premium. And that premium is based on a lot of things. Which coverage you took, how much coverage you selected, what is your deductible. All of those things are part of the cost of that insurance policy. So this week's assignment, just a little fast forward, you're going to see this. Your assignment this week is to purchase insurance on that house that you bought and that car that you bought. So whether you're able to actually buy insurance or not, I don't really care. I want you to go out and get a quote for insurance for yourself for the car that you imaginarily bought. And so there's lots of ways to do that. If you're actually insured, then you just call up your insurance agent and you say, hey, I want to get a quote. And you're going to be able to look at the coverages you currently have and say, let's see what happens if I raise my deductible, or I lower my deductible, or I add rental. You'll get to see, as you do this assignment, what all of the options are in your auto policy, including those 3 magic numbers for liability. There's 3 numbers that you're going to learn about as you prepare to do this assignment. As you get your quote, you're going to learn what those 3 numbers are. And as you read the content that's been provided for you, the resources, you'll understand that. But I'm not going to spend a lot of time on teaching that to you today. What I want to do is I'm going to tell you you're going to get a quote. You're going to have to put insurance in your plan. So you could go to your financial planning portal right now and you could say, okay, homeowners insurance, I need how much coverage? That's easy. How much coverage do you need? You need to at least have as much coverage as your mortgage, because the bank is going to require that you have insurance that covers the mortgage, even if you have a $500,000 mortgage, but it would only cost $250,000 to rebuild your house if it got burned down or blown away in a hurricane. Think about that. If you have a $500,000 mortgage, you have to carry $500,000 insurance on your house. Excuse me. Why do you think that is? This is your time to let me know you're not on Facebook and you're not watching Netflix. Why do you think the mortgage company has the right to require that you carry enough insurance to pay off the mortgage in the event that your house is destroyed by a peril that's covered under the policy, like fire? Fire is a good example. Anyone? Anyone got an answer? Why does the mortgage company have the right to require you to carry sufficient insurance to pay off the entire mortgage, even if your house to replace it would be half of that amount? Jewel, that's close. To make sure you're worthy of such a large investment, they've already done that. That's called underwriting. So that's not really accurate. The reason that they require you to carry enough insurance to pay off the mortgage isn't because they think you're qualified to pay off that mortgage. They want to know that if their property that they own, the bank owns your house if you have a mortgage, if it gets destroyed, they're going to get paid regardless of your financial situation. Yeah, it's just like car insurance, Ashley. To make sure you won't leave, just to make sure they get paid. That's the bottom line. So just something to think about, just something to understand is that you're going to have to insure your property, your house anyway, your home, for what the amount of the mortgage amount. So that's one thing to understand. Homeowners insurance is an interesting gig. The home has a coverage called replacement cost coverage. And so it's important. You're going to learn about that this week, but there's a difference between replacement cost coverage and actual cash value. So any property insurance has that distinction. Is it actual cash value or replacement cost? What do you think that means? Replacement cost versus actual cash value. So let's just take an example. I'm wearing some Bose headphones, and these, my wife gave these to me, oh man, it's been at least a year ago. I got them, I think, for Christmas, and they're great. I don't have a wire. I have another pair of these that has a wire. So replacement cost means I can go to Best Buy and I can buy these for the price that they cost brand new. To replace them, that's what I'm gonna have to spend. So that'd be a good way to insure my stuff, is with replacement cost. On the other hand, actual cash value, anybody have any idea what the actual cash value of this product would be? Actual cash value. What's the difference between replacement cost value and actual cash value? The difference is depreciation. So I told you these were a year old. They may actually be 2 years old. And one of the things that happens, like I wear these things when I'm mowing the lawn. Sometimes I go for long walks. Usually I wear my ear pods. But when I'm wearing these while I'm mowing the lawn, what do you think happens? I perspire. Yeah, so what happens is depreciation, because you wouldn't want to wear these after I wore them working in the yard on a 100-degree Saturday. Trust me, you wouldn't want to wear them. It'd be gross. So they're not worth much, right? That's the actual cash value. So if they cost $400 new and I wear them, say 20 Saturdays in the yard, perspiring heavily, what happens to them? They become used. And that's what happens with actual cash value, is you depreciate it. So imagine this. You own a house, and your house has a kitchen fire. So let's say that it's that $500,000 house, and you have a kitchen fire, and that kitchen fire is going to cost $50,000 to replace. But what happens if you don't have replacement cost? And let's say that your house was built the same year my house was built. And on top of that, let's say that your house, when it was built, has the same kitchen that it has today. So my house was built in 1980. That's 40 years. 40-year-old house, and we're assuming that the kitchen has never been upgraded. Now, that's not true for my house. Hopefully it's not true for your house if it was built 40 years ago. But just assume that it was. So what is the insurance company going to do if you have actual cash value coverage? Are they going to pay you the $50,000 that it's going to cost to come in and make repairs and put everything back the way that it was, like without any smoke damage or any fire damage? 50 grand is what the contractor and the restoration company are going to charge because of that grease fire you had in your kitchen. $50,000 is replacement cost. And then you have your deductible. Say it's 1% of the $500,000 that you carry on the house. How much are they going to pay if you have actual cash value? They're going to deduct the $5,000, so that's $45,000. But then what are they going to do? They're going to take away, deduct depreciation for materials that are 40 years old, and they're going to look at like the countertop. How long can a countertop last? A generous number would be 50 years. So that means you're going to get 10%, or maybe it'd be 20% of the cost of replacement. So the whole thing, let's say the whole thing, in fact, State Farm had this policy, they would never depreciate more than 50%, because like a good neighbor, that was the policy, and pay what we owe, no more, no less. But that was a policy they had that was just a good neighbor policy. They would never depreciate more than 50%. So in this scenario, how much would you receive on your actual cash value policy? You had a $50,000 loss, a $5,000 deductible, and they're only going to pay 50% of the replacement cost. So you're talking about basically 25 grand. Another little inside baseball is they would absorb the deductible and the excess loss. So you'd basically get paid 25 grand. You don't need to know that. There's no test. There is a quiz, but no test. But anyway, I just want you to understand that as a consumer, that's one coverage you're going to want to make sure you're getting on your homeowner's quote, because you could get an actual cash value policy for a huge reduction in price. There are insurance companies out there that will sell you an actual cash value policy at a fraction of the cost of a replacement cost policy. So it's one of the things to understand, and that's replacement cost coverage versus actual cash value. Same thing works with any property insurance, but your house is a big asset. It's a big number, and it's something you should know. So let's talk about some other coverages. Let's start with the homeowner's policy. So the homeowner's policy comes as a package. It has property. What do you think is covered under the property section of your homeowner's policy? I'll just tell you. The house, okay? The house itself is covered. There's another thing called, I forgot the name of it. It's additional, it's not the house, but it's other buildings. I forgot the name of it. But basically, the house is covered for 100% of the policy limit. But other buildings, outbuildings, like if you have a detached garage or a shed, or a swimming pool, or other pieces of property on your property, they're only covered for 10% of the coverage amount. So you got the house, and then you've got these additional extended dwelling. I can't remember what they're called. You'll see that on your declarations page. But anyway, that's how that works. So the house is the big thing. And if you have replacement cost coverage, you're much better off than if you have actual cash value. So then in addition to that, what other property would be covered in your homeowner's policy? Well, I mentioned, my earphones and everything else I own, including my phone, my glasses, my iPad, the computer here, this microphone, everything that I own is personal property. Some of it's business personal property, which is a different category, has a different limit. But just so you know, your property, your homeowner's policy, it's a package deal. And the property section covers the house, either actual cash value or replacement cost. It covers your personal property, also either replacement cost or actual cash value. One of the distinctions I want you to understand about the home is some homeowners policies, and this is true in Texas, give you a coverage that's much broader than a named peril coverage. So think about it like this. If you have a policy, any property insurance that's named perils, that means you're covered only for those named perils. Fire, lightning. What about flood? Do you think flood is covered in most property coverages? It's not. Flood is one of those things that's a huge risk. And so you need a specific policy to cover flood for both your home and your personal property. So just be aware of that. One of the first exclusions in a homeowner's policy is flood. Exclusions is another term you're going to want to understand. Every property insurance policy has exclusions. It makes sense, right? Flood is the biggest exclusion of all. When I was a State Farm agent, I told every single client who ever hired me that they needed flood insurance. You live in a coastal area, and the answer would sometimes be, yeah, but it's never flooded. The bank doesn't require it, so we're not going to buy it. And I was always very, very clear. And if any of you know anything that happened in Hurricane Harvey, like me, I had lots of friends, a number of friends, who did not have flood insurance. Well, when I was a State Farm agent in Clear Lake, every single person who bought homeowners insurance from me got the same speech. And basically, it was as close to rude as I could be to tell someone, this is a no-brainer. If you don't do it, A, you don't trust me, obviously. You don't take my advice seriously. But B, you're an idiot, in my opinion. And that was the truth, because the cost of flood insurance is really low compared to any other insurance you could buy. For the risk and reward ratio, there's no better deal than flood insurance if you own a home in the Houston area, especially if you're down where I live. And the more they build roads, the less the water has a place to escape to, the more and more and more likely it is that you will eventually have a flood, which is what we saw in Hurricane Harvey in an epic proportion. So flood excluded. You should know that. Flood is not covered under your homeowner's policy. You need a separate policy. Some parts of Galveston County, you need a wind policy because your homeowner's policy has another exclusion saying if you live on Galveston Island, your homeowner's policy very likely is not going to pay for damage from a hurricane. So think about that. You need to know that if you buy a house in Galveston and you go to buy insurance, you need to know that. That's a huge, important detail. And as a consumer, you need to know that. So exclusions are important. Named perils are important. But the insuring agreement, that's what tells you what kind of coverage you get from the start. And the insuring agreement has this language that, at least at one time, I think it's still the same today, it's called all risk of physical loss. APL is what we called it. And if you had that in your policy, what that basically meant is that your home, not your personal property, that's pretty much always named peril. But your home, the house, that big asset, it's covered for all risk of physical loss. Now think about that for a second. The concept of all risk of physical loss, what does that mean? It basically means it's covered. No matter what happens to it, it's covered, except for an exclusion. So if there's an exclusion, then it's not covered because it's excluded. So for example, I could have my house, which I do, which has all risk of physical loss. It's a very broad form of insurance for my home, and I have replacement cost. And anything that happens to my house is covered unless it's excluded, which flood is excluded. Inherent vice, rust, rot, mold, things that don't happen sudden and accidentally. If it's a sudden and accidental loss, it's covered unless it's excluded. That's kind of inside baseball, but it's a very valuable thing to understand if you're a consumer and if you're spending a lot of money on a homeowner's policy, because here's why. You could spend more to have the all risk of physical loss and the replacement cost coverage on this package, or you could spend a lot less and have named perils and actual cash value on this policy. But what you're getting is significantly more valuable. Now, I'm not saying it's worth twice as much or 3 times as much. You have to figure that out for yourself, and it has to be based on your financial situation, because if you have a loss that's not covered, you better have an emergency fund to pick up the difference. The same thing is true with your deductible. If you have a great big deductible so that you can lower your insurance, you better have the money in the bank in your emergency fund. I'm not saying that's a bad idea. You might make a lot of, over the years, you could never have a claim, never use that policy, and be way ahead of the game. But if you live in Houston, you might want to think about it. You at least should know. So next we get into liability. I'm going to tell you a story about liability, and then we're going to move into auto insurance. We're running out of time. So liability is a big concept. You should understand it. You should also do a little research and understand you should understand what a personal liability umbrella policy is. So if you're taking notes, just make a note. What is a PLUP, personal liability umbrella policy, and how does it work? So your homeowner's policy, I told you, is a package. Section 1, property. Section 2, liability. Section 2 has more than one coverage. One of the coverages is called liability. Most policies come standard with $100,000 of liability. That's not very much. So for $25, you can raise that to $300,000. Not a bad deal. I would do that. So liability comes with some benefits. So for example, let's say that you come to my house and I am in the middle of a project. I'm digging a hole to fix my plumbing because I have a leak, and I have to dig out the plumbing in my yard, and it happens to be right at the sidewalk, and you're walking by my house and I don't have any markings. It's kind of dark, and you trip and fall into the hole and you really get hurt. So my homeowner's policy protects me and my family against liability claims, which means if I'm at fault or if one of my family members are at fault and we get sued, our insurance company is going to pay to defend us in court, and they're going to pay any claims against us that we lose because we're at fault. As long as it's not excluded, as long as it's not an intentional act. But that wasn't intentional, that was just stupid. For me to dig a hole, leave it open, and then one of my neighbors walks along with their little child, falls into the hole and breaks their neck. I'm liable. I'm at fault. And my insurance company is going to have, when I have a judgment against me in court, they're going to pay that judgment up to the limit. If you break your neck and you're a physician or a surgeon and you can't ever work again, the claim against me is going to be super high because I'm going to have to pay for your lost earnings. And you make more money than I ever dreamed of making. And so in that case, my $100,000 is going to get paid. The insurance company is going to write that check immediately and hand it to you. But you're still looking for another $1 million or whatever. So what happens next? That's the question. So having liability insurance is kind of like you can have insurance on your house, but if you don't have replacement cost insurance, you're kind of screwed. If you have a fire or another covered loss. So liability is the same kind of thing. It's like if you have liability insurance, but you don't have enough, well, that helps. And for most people, it helps a lot because, statistically, the chances of you having a claim brought against you, that you lose a judgment in court and have to pay $100,000, that's a very tiny little statistical chance of that ever happening. I'm not trying to scare you, but as an insurance salesperson, I could use that to scare you pretty easily and say that's not enough. And frankly, for $25, I'd say that's just kind of that's a no-brainer. Pay the $2,500 instead of $100,000. You have $300,000. And when you learn about the PLUP, the personal liability umbrella policy, you're going to discover that for like a couple $100, You can put another $1 million over and above your homeowner's liability coverage, and it goes over and above your auto insurance liability coverages. So just think about that. Is it worth a couple $100 a year to have $1 million coverage over and above your home and your auto? And today it's not for you, typically, no. But for me, if you got $1 million in the bank that could be attached to a lawsuit, not a bad idea, which is why people do it all the time. They buy PLUPs. You don't need to buy a PLUP today, but one day, I'm hoping, you will. And so you should know what a PLUP is. You should know what liability is. You should know how that works. Another coverage in your homeowner's policy package, it's called medical payments coverage, and I love this coverage because this coverage gives you something that the liability doesn't give you. It gives you almost immediate access to payment from your insurance company for anything that happens as a result of your activities or as a result of your property. It could also your activities anywhere in the world. Not only you, but if you're me and you got kids and a wife and a dog, anywhere in the world that somebody gets injured or some property gets damaged, I'm covered. But medical payments coverage, it pays medical bills. And here's the key. You don't have to be liable for it to pay. So it doesn't matter if it's your fault or not. If it happened on your property as a result of your activities and there were medical bills involved, your insurance company under medical payments coverage is just going to pay that medical bill up to the limit, which is usually only $1,000, but for a few bucks you can get it all the way up to $5,000. And it's a great coverage. I call it the true good neighbor coverage. Here's how it works. So my son, Brandon, when he was I think he was 10 years old, he was at school, it was recess, it was a beautiful day. He's walking across the parking lot, he's wearing shorts and tennis shoes, and they're in a line. The students are going to recess to the playground, and his shoe's untied. And one of his little buddies thought that was just so cool that here's Brandon walking across the parking lot with his shoelace dangling behind him. So the little kid decided he would stomp. I would love to show you. If we were in class, I would walk down the aisle and I would show you exactly what the kid did. But you can imagine he stomped on the shoelace. And what do you think happened next? Brandon fell, and he was on asphalt, and he cut his knee, and it was a nasty cut. Had to go to the emergency room, had to have it sewed up. And at the time, I had health insurance, but I had a huge deductible because I was doing this thing called HSA, Health Savings Account, which was a tax deductible contribution to a savings account. And you get a tax deduction, and you can use it for medical bills, but I had to have and you have to have a big deductible on your health insurance to have that. So I did, and we hadn't had a claim that year. We were all healthy. Nobody went to the hospital. But then we have to pay like it came out to be nearly $1,000 for Brandon to go to the emergency room, get it sewed up. So knowing what I knew about insurance, because at the time I was kind of a new adjuster at State Farm. I was going to claim school. I was learning all these cool things about these coverages. And I knew that homeowner, that little kid, I'm assuming they had homeowners insurance or renter's insurance, I was hoping. So I called him up and I told him what happened. And I said, look, I'm not blaming you. It doesn't really matter whose fault it was. But as a result of your child's activities, this is what happened. And because it was a result of your child's activities, even if you're not at fault, even if it was an accident, doesn't matter. It still costs me a lot of money, and I'm asking you to do me a favor. What do you think they thought when I asked them to file a claim on their insurance for medical payments coverage? What do you think they thought? What would you have thought if I asked you to file a claim on your insurance policy because of something your child did at school? How would you feel about that? I can tell you this, that my insurance was going to increase. That's a great, who said that? Vanessa, that's a great point. You'd think, I think most people think that. So I was smart enough to explain to these dear folks, that it won't impact your insurance cost at all, and that's the truth. It's not going to get you canceled unless you have a lot of claims like this. But if you've never filed a claim, I promise you're not going to have any trouble at all. You're not going to get a rate increase, which is true. Your insurance company's going to take the medical bill, they're going to look at it, and they're going to write a check. It's the fastest, easiest claim that will ever be processed, and that's the truth. That's what makes it such a great coverage. And you would think maybe they would refuse, but when I helped them understand what it was and why that coverage even exists, which is the reason that coverage exists, is so that things like this can be taken care of without out-of-pocket expenses. And if the tables were turned, I'd be happy to file a claim for you if my son had done that and your son had to go to the emergency room. So please help me out. I'm a poor working man. I mean, I basically sold it to him. But the point is, it didn't cost them anything. It wasn't going to raise their insurance. And no, they had no clue that coverage existed. And neither did you until now. So I had a dog named Hershey. Hershey was the ugliest dog you've ever seen. Frankly, when Hershey died, I celebrated. I don't miss Hershey. Oh, my wife and my daughter, they would be upset if they heard me talking this way about Hershey. But Hershey was a Yorkie poo, which means he was half Yorkshire Terrier and half poodle, which means he had really long, skinny legs. And he was black, and he was my daughter's dog. And it's a long story, but Hershey didn't like me because when he was a very small puppy, when we brought him home, my daughter, who was very young, I would get in bed with her and I would tickle her, right? I would tickle my daughter until she laughed and screamed and made a lot of noise. And the whole time Hershey would be bark, 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 because Hershey was my daughter's dog and he was trying to protect her. And I wasn't smart enough to know that I was creating a vicious creature. Hershey turned out to be an ugly, vicious creature. And he didn't like me at all. And at the end of the day, I was just glad. Now I have Lucy. Lucy's the best dog I've ever had. I'll show you a picture soon. But anyway, so Hershey, my daughter, was young, and one day she got up fast and she stepped on Hershey. And he had these long, skinny legs, and she broke his leg. And so I had to take Hershey to the vet, get his leg put in a cast. So he's walking around in a pink cast for, 6 weeks or no, I don't even remember. But he was in a cast. It was something to see. Finally, Hershey gets the cast off. And Carissa, my daughter, brings her friend Kayla over to spend the night. Well, Kayla is in the bathroom getting ready for school. She's putting her little, makeup. I'm not really sure. But she picks Hershey up and she puts Hershey on the counter. Sorry about that. And then, of course, Kayla decides to wander off out of the bathroom and she forgets all about Hershey. And what do you think Hershey does? What would you do if you were Hershey? Hershey was a he, so he fell. Yes. Thank you, Vanessa. He fell. He didn't fall. He jumped right off. And then what do you think happened to Hershey with his newly healed, big, long, skinny, ugly as homemade sin Yorkshire Terrier leg? Another crack. Yes, Philip, it broke again. So I had to take him to the vet. This time the vet was like, oh, we're going to have to put bolts in it. $1,500. I'm like, I literally asked the vet, Dr. Pickle. She remembers to this day. I told her a story about a dog named Skeeter that used to live by me in Michigan. And Skeeter would chase cars. One day Skeeter got too close to the car and it ran over its leg. And those people didn't do anything to take care of that dog's leg. He drug it around all summer until you could literally see the bone. It was the grossest thing. He had this dead leg that he just carried around. Finally, they took him to the vet, and the vet cut off his leg and shaved half of him. Brought that dog, Skeeter was his name. He was an ugly black dog too. As soon as they brought him home, guess what he did? He started chasing cars again. He never missed a beat, and he was a three-legged tripod. And so I thought about Skeeter, and I said to the vet, how much would it cost if you did a Skeeter on Hershey, if you amputated his leg? Because $1,500, come on. Seriously? Do you know what Dr. Pickle said to me? Do you know what my daughter said to me? Do you know what my wife said to me? It was not pretty. And I lost that battle and almost regret even ever making that recommendation or suggestion. So we paid the $1,500. And then I picked up the phone and I called Kayla's parents and I explained to them this coverage called medical payments coverage. And they didn't know about it. And I explained it wouldn't raise their insurance and that the coverage was specifically designed to pay medical bills. Now, you're probably thinking, but it was a dog. And I was thinking the same thing. I wasn't sure it would work, but I knew this. It was a medical professional, a veterinarian, a licensed person, so it was worth a try, and it worked. My insurance company was State Farm, obviously, since I was a State Farm agent, and I don't think they did it just because I was an agent, but they paid the claim. So the point is, medical payments coverage is a very important coverage to understand. Now, before I let you go, I know we only have a few minutes, but I want to explain a little bit about auto insurance because I told you about all risk of physical loss. So all risk of physical loss on a homeowner's policy is one thing. But on an auto policy, and you're going to learn this week, you're going to have to discover the different coverages that are in an auto policy. Liability coverage, uninsured coverage, there's a whole list of them. Rental coverage, but there's also a thing called comprehensive coverage. And I want to spend the last couple minutes talking about comprehensive. What do you think that coverage even covers, comprehensive? Marcus, let me get to that question when I finish this story. Or, you know what? Maybe I should tell you these stories. We're pretty much out of time. So I've got some more stories about auto insurance that I think you'll find helpful, and I'll save those for next week. So the question is for your homework, how would I like you to input each insurance coverage from your homeowner's insurance into your financial plan? And when you get into your financial plan, you're going to see how to do that. And naturally, this Friday, when I do the review, I'll show you if you missed it, but it's really pretty simple. I'm assuming, Marcus, that you haven't actually looked into your financial planning portal to see if you can answer your own question. If I'm wrong, please let me know. But I think once you do that, you'll see and you'll be able to answer your own question. There's no option to put specific coverage like dwelling and personal property if you're... Yeah, so I guess the answer is you don't really need to get that detailed. I just want to know how much coverage, and that is in there, and the premium is the main thing. So when you get your homeowner's insurance quote, or if you do get a homeowner's insurance quote, you'll see each of those coverages that you're mentioning. But you're right, there aren't fields for each of those specific coverages. So don't worry about that. I'm not looking for that much detail. What I really want to know is that you've thought about how much and how much. How much and how much. In other words, how much coverage do you need and how much is it going to cost? Because if you go and say, I've got a house in Friendswood, Texas, it's a $500,000 house, and my insurance is going to cost $600 a year, I'm going to say, that's not the right answer, because insurance is much more expensive than that in Friendswood, Texas. So just have an idea how much insurance you need based on your mortgage is an easy way to do that. But then how much is it going to cost? And so you may have to do a little research to figure that out. But I don't expect you to spend hours on this assignment. It should be relatively easy. Same with the auto insurance. I see someone shared a screenshot. Cool, Marcus. I appreciate that. I think you shared the screenshot. I'm going to click it again to open it. Okay, I'm looking at your screenshot now. So let's just talk through this. I wish I could share it. I guess I could. I could share it. Let me see if I can share it. Boom. going to try to share this. Give me a second. I'm sorry, I'm a little slow. Okay, here we go. Screen, I'm looking for screen. There we go. Open. Screenshot. Huh. I've got it on my screen, but it's not showing. Well, sorry about that. I can't get it to show, so let me just walk through it real quick. Yeah, so here we go. And you've got an investment property here. Marcus, I think you're in the wrong data card because you're looking at an investment property and you want to be looking at your homeowners. But you know what? Let me do a little. I'll do a little work on that when I assign the assignment. When I post the assignment, rather, I'll make sure that you get that question answered very clearly. That's a great question, and I appreciate that. Do you want us to add the homeowner insurance into this category? Because I don't see. So check out. I think you're in the wrong card. You've got an investment property there open, Marcus. But I'll do this. We're out of time, so I'm going to have to wrap it up. But what I'll do is when we finish this call, this Zoom call, I will go in and create a GIF, and I'll just open the data card, and I'll show you which fields we need to be putting. And I'll post that in GroupMe right quick. So hope that helps. That's a great question. I appreciate that. Yep, the answer is yes, though. I want you to put the insurance in your homeowner's data card. Same thing's going to happen with your car insurance. But the main thing in this assignment this week is going to be getting a quote for your car insurance. So again, I told you at the beginning, the easiest way to do that is if you already have insurance, if you're actually driving a car, even if it's on your parents' policy, just grab the deck page. That's the declaration page that shows the coverage, or the ID card, either one. Call your agent and ask for a quote. Have them walk through the coverages with you. That's the best way to learn your auto insurance coverages, is to have a professional talk you through what each of the coverages is and how it works. It'll help you know whether or not your insurance professional has a clue too, because sometimes if you're working with an insurance office staff person, sometimes they don't know. The agent will know, but their staff may not be very well trained. So you may want to have a few minute chat with the agent. But that's what your challenge is this week. I want you to learn what those coverages are. And the way I'm going to ask you to do that is just get a quote. And you can do that online, but the easiest way is to do it with a person that you already have a relationship with. So if you don't have car insurance, you're going to have to just go online and get a quote. And in the process, the assignment is going to ask you to tell me why you chose those coverages. I just want to know that you know what it is you're buying. And so this is a great opportunity for that. I don't expect you to spend a whole lot of time. Insurance, again, is one of those things that you're not going to be an expert on. I can't make you an expert. What I'm trying to do is make you a well-informed consumer. I want to teach you how to ask the right questions, teach you how to do the right kind of research in the context of insurance. So next week we'll come back. I'll tell you some more stories. We'll talk a little bit about life insurance, health insurance, long-term care insurance, disability insurance, and we won't have enough time to cover nearly everything, which is unfortunate. But hopefully this has been helpful to give you a taste of insurance from a consumer's perspective, because you're going to spend a lot on insurance, and it's kind of complicated. And if you're working with a professional, it's kind of hit or miss. So you might want to get a second opinion before you spend the big bucks on a big policy for whatever it is, whether it's a homeowner's policy, a life insurance policy, health insurance. You may want to get a second opinion before you put down the big bucks on any of those kinds of policies. So hope that helps. Thanks for being here. We'll see. I'll post the assignment with some clarification. and I'll post that in Blackboard, and I'll also post it in GroupMe. So thanks. We'll see you later. See you Friday. Have a great day.